Hi everyone, Chris Camburn here with an episode of what I'll call Market Stats and how this came about. Folks always wonder, should I invest in stocks or should I invest in bonds? To which I often respond, well, it depends upon your time frame. And I started keeping, over the years, then I started to create a spreadsheet and keep stats for, well, if you invest in stocks, what's your probability of success? And if you invest in bonds, what's your probability of success? And it's all based upon historical data, so there's nothing predictive or forward-looking or promissory here, as past performance is never indicative of future results. But if we look to the past, hoping for answers for the future, I mean, maybe these statistics will come true again. I don't know, but I think it's a starting point. So let's run some compliance disclaimers and come back and get into it. So when I say stocks versus bonds, stocks are, I measure them by the S&P 500 index, and I measure bonds by the Barclays Total Aggregate Index. The S&P 500 index is pretty well known. It's 500 large cap stocks here in the United States. And the Barclays Aggregate Index it's investment grade government bonds and corporate bonds, and there's about 10,000 bonds in the index. It's impossible to invest directly into an index, but there's index tracking products, and I don't discuss individual securities, as I just simply I don't. It's kind of tough to do to get through compliance and all that. But if you follow the indices, you get the general gist. And so let me give you the punchline right away. Let me give you the data, and then I'll explain kind of where I get it from. Or excuse me, let me show you where I get the data and then the punchline, then we'll kind of backfill. So where I go for data for this is through Yahoo Finance, right? If you just go to Yahoo Finance and you find the S&P index, you can get historical data. I go back as far as possible on this. And at one point I was able to export the data big time. And now I just fill in the pieces and I get month-end data and I plug it into a spreadsheet. And I do the same for the Bloomberg U.S. Aggregate Total Return Value Unhedged USD. This is basically the big bond index everybody uses. And again, I get the month-end numbers wherever they may be, and I plug it into my spreadsheet. And so I have information on the S&P going back to January of 1950. And information on the Bloomberg bond index going back to December of 1975. So what this shows is on the S&P from January of 1950 through July of 2023. It's August of 2023, so I go to the previous month end. And since 1950, January 1950, there's been 883 one-month periods. These are all the rolling periods. So 1 month is March to April, June to July, November to December. A rolling 3-year period is, say, January of 1970 to January of 73. March of 1985 to March of 1988, right? That's a 3-year period. And as far as rolling 3-year periods, so March of 85 to March of 88, April of 85 to April of 88. That's a rolling 3-year period. And since 1950, there's been 847 of them. And rolling 5-year periods, rolling 10-year periods. And this is the S&P probability of success. So for this time period measured, again, just this time period measured, perhaps we can extrapolate some of this data going forward, but it's no guarantee. And it's so variable, you can't predict going forward. So for every 1 month period, the S&P historically has increased 60.25% of the time. And for 1 year, that's been 73% of the time. 2 years, 82% of the time. 3 years, 84% of the time. 5 years, 10 years, 92% of the time. And over 20 years, there hasn't been a 20-year period where the S&P has been worth less after 20 years than prior. Not to say that won't change in the future. It's just the way it's been in the past. So conversely, if we take 5 and 10 years, it's increased 83% of the time, but it's declined 16.65% of the time. For 10 years, it's increased 92% of the time, but 8% of the time it's been down. Then for each data set, I kind of drill down into those a little bit more. I say, well, for every rolling 5-year period, that is, its average returns have been 51.16. That's cumulative, not annualized, right? So over the average 5-year period, your $100,000 investment, let's say, has gone to $151,000 and change. And for 10 years, your $100,000 investment's gone to $218,000 and change, right? That's been the average for those rolling periods. And then what I do is I break it down. Well, for the amount of time when it's increased, what's been the average increase? And when it's decreased, what's been the average decrease? So when things are up for 5 years, they're up 63%. For 10 years, 130. But when they decline, the average decline for 5 years, right? 16% of the time after 5 years, the S&P's been worth less in this measuring period. Its average decline has been 11.3. That's total. So $100,000 becomes $88,700. Or if it's down 13%, it's down to almost $86,000, right? So that's been the average decline. And then the maximum gains, right? Well, what's been the best 5-year period? Well, $100,000 became $319,000, and for 10 years, your $100,000 became $470.51. So you have to add your original investment back to the gains to get your total amount. However, look, 16% of the time, every 5 years, the market's down, and its average decline is 11%, but its worst has been almost 36%. And for 10 years, its worst has been just over 40%. So on a $100,000 investment, you might have had $65,000, or you might have had $60,000. $1 million investment would have declined to $650,000 or $600,000. So, from ages 50 to 60, that could be hurtful. From maybe 60 to 70, that could be more hurtful. 70, 80, more hurtful. You get what I mean? So I ask people to give some consideration to these stats when we put together investment accounts. Now, conversely, it's called stocks versus bonds. I mean, during the measuring period I have on bonds, I think I need to get this on the same screen you can't really see it. Let's look at bonds first, then we'll try and put it up there with stocks to put them on the screen at the same time. So since December of 1975 through July of 2023, this is the amount of measuring periods. And let's look at some select periods. For every month, now there's a 66% chance, or historically, the Bloomberg U.S. Aggregate Bond Index has increased every month, 66% chance that month over month it's up. 86% chance that in 1 year it's higher. 94% historical success rate over 2 years, 96 over 3, 99 over 5, and 100% of the time over the past, in this marking period, right? This is historical looking, not forward predicting. There hasn't been a 10-year period in this measuring period where bonds lost money. And it's versus stocks, which only increased 92% of the time relative to 100%, and 83% for 5 years versus 99 for 5. So then let's look at some data. So the average returns when bonds increased during the increasing periods for 5 years, the average increase was 43% for 5 years and 111% for 10 years. And then the average decline, when it's declined for over a 5-year period, has been almost 2%. So if the average decline was down 11% for stocks, it was only down 2% for bonds historically. So that's why people sometimes choose bonds over stocks for shorter periods of time. The best time period bonds had ever had in this marking period over 5 years was 151% increase, and the worst was off 3%. So the average down 2, the worst almost down 3. And the worst 10-year period over this measuring period was 7.664. I mean, that's not bad. Now, something I noticed when I was going through this data is, let's see if we can't just get that on one screen for you. I hope that's visible for you, that, again, the average amount over 5 and 10 years. Let's even do 3, 5, 10. 3, 5, 10. Common periods for investors. Well, let's even get 20 in there because there's some interesting data out there. Again, 84% of the time historically in this marking period over 3 years, the S&P increased. 83 over 5. And that's versus in the 90s compared to bonds. Bonds historically in this marking period had increased every 10-year period, rolling 10-year period, versus 92% for stocks, with an average increase. Here's what gets interesting. In these marking periods, right, this is not the most recent 10 years, but this is the average of these rolling 10-year periods. Stocks averaged 118% increase, and bonds 111, almost 112. Call it 119 versus 112. You averaged a total return, so not annual return, a total return of 7% more using stocks over these rolling 10-year periods. I mean, I'm just saying that's not a lot, in my opinion. No, average of $7,000 more per $100,000 or $70,000 per million. Yeah, I mean, that adds up, can be big money, but if you're putting in money, taking out money, making withdrawals, you don't like seeing your account decline, it might be worth it to be a little bit more bond heavy. And I found this really interesting. For these measuring periods, the average rate of return for bonds rolling 20 years during this measuring period, the average performance has been an increase of 339%. So $1 million went to 439. Well, I guess $1 million went to 4,390,000. $100,000 went to $439,000, and versus bonds, which are just 0.6 less. I mean, same performance for bonds versus stocks nearly. On average, for 20-year rolling periods. For 30 years, stocks go on to exceed a little bit, but for 10 and 20 years, the average rolling 10 and rolling 20-year performance for stocks and bonds has been really, really close. Now, keep in mind the most recent 10-year period. This is the most recent, right? This is where all the data comes from, the most recent 10-year period. Stocks have increased by 172%, and bonds, most recent 10-year period, have only increased 16%. So $100,000 became $116,000 in bonds versus $100,000 became $172,000 in stocks in the most recent rolling 10-year period here. I mean, that's a big difference. But the average over these time periods has been nearly identical. I mean, I just found that really incredible. And so I had to fact check, well, how was that? And so here we are for bonds. The most recent rolling 10-year period and 20-year period, let's do both of these at the same time. I have both columns. Most recent 10-year period, bonds have increased by 16%, and most recent 20-year period by 87%. But if I go back to the first 20-year period I captured, right? My data started in 1975. This here, just bring your attention, see the movement on the cursor. This is 1995. So if my data started in 1975, right, add 20 years, that takes you to 1995. So that's my first ending 20-year period. And bonds had increased over that 20-year period by 580%. versus 87% for the most recent 20-year period. The rolling returns of bonds have been coming down. 10 years, it's 150 for a 10-year period ended in 1995, 171 for the period ended in 1985, all the way to 16% for the most recent 10-year period. Way, way, way down. And that's though, although interest rates have increased this year over the past 12 months, perhaps, I forget when they did their first rate hike, interest rates have been coming down for the past 20 to 30 years. And you can fact check that through the U.S. Treasury yield curve. Here's the yield curve right now for 10 years. We're at 442, right? That's a 10-year bond for 442. Excuse me. I had this up for something earlier. So for the 10-year period, right now we're at 4.2%, right? For the most bond rates right now for 10-year government bonds are 4.2. 20 years ago, so 2003, interesting, 4.42, not much more. But how about for 1983, right? 1983, 10-year bonds were paying 11.65%. How about 1993? 5.42. All right, so that's where the 10-year has been. And if you just look at what's called the federal fund rate, this is when they raise or when they lower rates. This is the rate they're trying to impact. Here we are, March, April, June. This says July of 2023. Look at that. Oh, one of my pictures in the way. Right here, July of 2023, the federal funds rate's at 5.12. And here, they had been very low rates for many, many years. They raised rates, they lowered rates, they raised rates again here recently. But back in 1982, the federal funds rate was at 14, 89, 981. Oh, here's the 10 line right here where my mouse is, the pointer. And you can see, look, everyone knows for the past 30, 40 years they've been lowering rates. Now, will these rates, they say they might keep increasing rates. Will we see these rates be up here again? This is how Paul Volcker was trying to calm inflation from the 70s. He really raised rates precipitously. Will we have to do that again? Well, inflation seems like it's in check, but there's still some readings. It's touch and go. However, I think what I conclude from this is we may see, and so 10 years ago was 2013. Let's just get this here. 2013, call it August, see my cursor, August 2013, the federal funds rate was at 0.8. And we've had only an 87% increase in bonds for the past 10 years. But here, last time the federal funds rate, call it June 2007, the last time it was at 5.25, which is nearly what it's at today, 5.12. Go with me here. January 2007 is the midpoint of that to June 2007. Let's see what my data says. That would be 2017 on bonds. 10-year returns on bonds ending in 2017. Interesting. 10-year rolling periods ending 2017. So 2007 to 2017. That's it. Well, the 10-year return on bonds, I stand corrected. I'd say at 87%. It was 16% for the past 10 years, right? And we were at, near zero 10 years ago. So here's 2017. So rates were at 5% in 2007, and we eked out 48% total returns for the 10 years from 2007 to 2017. I think that was even the summer of 17. So, call it 50%. 50% total returns from the last time we had rates around 5%. I'm curious here, October 2000, I can't help myself but going through this stuff. October of 2000 to October 2010, 10-year numbers, 85. So 1% higher. It was October of October of 2000, rates were at 6.5%, the federal funds, and we eked out 85% for the next 10 years. So, you know, it just says the higher the federal funds rate is, the better bonds will do, for the future, call it 10-year period roughly. So whereby for the past 10 years, we've seen a 16% increase in bonds. The last time the federal funds rate is where it was where it is today, we eked out 50%. But also, look at that, they lowered bonds quite quickly and kept them low. So somewhat encouraging that the next 10-year for bonds will be better than the previous 10-year for bonds from this data. That's just my conclusion. It's a hypothesis. But it might come to fruition. So it should be something for you to consider when you think about stocks versus bonds. Let me get over here again. Stocks versus bonds. Likelihood of success in investing in stocks or bonds over your time frame, and then what you should do. Something else. So I thought this might be of interest. In as much as we can get generally 5% yields on money markets, 1-year treasuries, 1-year CDs right now, I thought, okay, well, what's the likelihood of stocks exceeding 5%? My first set of data is stocks exceeding 0, just being positive. So let me get. How about stocks? Let me format that properly. How about stocks instead of just exceeding 0, exceeding 5%? Let's do this: average plus, average minus. Right. That looks a little bit better to read, right? Plus, minus, just get some colors in there, just for optics here. So returns better than 5%. I've the data points here where I have a hurdle rate. So the trigger of 0. If I put the trigger at 5%, just go with me here. Now it's showing the amount of times during the same time period returns exceeded 5%. So I have to cut and paste this data, right? Periods over 5%. Cut and paste the data. So now that's hard-coded as 5%. And let me go back, adjust the trigger back to 0 because the live data up top, right? So we have the 60.25% of the time it's greater than 0. And but only for 1 month, but only 12% of the time is it better than 5% for 1 month. And then let's go to 3 years. 80% of the time we exceed 5% a year returns versus 3-year returns, 84% of the time. All right, so it makes sense. We earn more than 5% less than we just simply beat 0. For 5 years, 80% of the time, the market's beaten the 5% return. For 10 years, 90% of the time. 20, still 100% of the time. But for 3, 5, and 10, 80, 80, 90, 3, 5, and 10, 84, 83, 92. Right, not that big of a difference between 5-year and 10-year. I can't get that on the same page and have it legible there on the screen for you guys, but to return more than 5% over 10 years, the market's done it 90% of the time. We're simply being positive. It's occurred 92% of the time. So not that big of a difference, but definitely on the somewhat of a material difference on the 3 and 5 year numbers, but most striking is between stocks and bonds. So that's just the information. That's just data, historical data. It says nothing about what's going to happen going forward. But I thought just interesting to see stocks versus bonds over different time periods, different rolling time periods, and just just stats of the market. I mean, I do rely on these, on stats. I do use these. And I just thought it might be interesting to share them with you. So hope you found that interesting, and talk to you soon.